Hello everyone, welcome to episode 1 of this series. I'm going to be diving into the basic 3 PD arrays that I use. This will just be a very beginner friendly video. I'm going to dive into order blocks, fair value gaps, and breakers. And we'll also be talking about sell side liquidity and buy side liquidity, or as I have noted, sell stops and buy stops here. I'm not going to be talking about the model in this video, but you need to understand the basics and the fundamentals behind these 3 PD arrays before you can understand the model that I'm going to teach later in this series. So the first PD array that we're going to be covering is the fair value gap. If you already know fair value gaps, breakers, and order blocks, you don't really have to watch this video, but I still think it is important to understand these and really understand them like the back of your hand, because if you don't, you're not going to be able to recognize the model as easily. So this is what a bullish fair value gap is. It's essentially a buy side imbalance, sell side inefficiency, so it's labeled as BISI fair value gap. The bearish fair value gap is labeled as SIBI fair value gap, or sell side imbalance, buy side inefficiency. So in the BISI fair value gap, it is a 3 candlestick pattern. When you have a candle number 1 like so, where the upper wick and the lower wick of candle number 3 up here do not overlap, it creates this gap. So if you notice, this is candle number 1, this is candle number 2, and this is candle number 3. Candle number 1's wick, the high of that, and candle number 3 up here, the low of that wick, they don't touch. So between this candle wick's low and this candle wick's high, they're not touching. Only the body of candle number 2 traded through that area. That is the ICT fair value gap. A bullish fair value gap is called a BISI, or a buy side imbalance, sell side inefficiency, because it only offered buy side delivery in this fractal price action between this wick's high and with this wick's low right in here. So within the model that we're going to be teaching later in the series, what can happen is price can return back to this fair value gap, and it's an area where sometimes it will refill it in to rebalance the inefficiency which price created. Once price taps the low end of a fair value gap, and then it leaves that area and expands higher, if it completely fills it in and then leaves that area and expands higher, this becomes a rebalanced area because it's inefficient in price delivery here. So once it pulls back down to the low end of it, that's called a repricing once it touches the low end. Once it breaks higher or lower in either direction and leaves that range, this becomes rebalanced, that fair value gap. Similarly, in the bearish idea, it is a 3 candlestick pattern. We have, this is candle number 1, this is candle number 2, and this is candle number 3. So candle number 1 is always going to be the start of the fair value gap. You look at that lower wick right there, and then the upper wick of candle number 3. So really, you're just looking to see between candle number 1's low and candle number 3's high, their wicks, are they touching? If they're not touching, it will always create this gap, or this imbalance in price. So this is called a SIBI, a sell side imbalance, buy side inefficiency. It is a bearish fair value gap. It's just the labels that ICT gives it. So in this example, if price were to pull back into here in the model, you'll see that later in the series, this is an area within the specific model that we're going to be looking at where we anticipate for price to reverse at and starts to continue lower. Similarly, in this idea, if price were to reprice all the way back up to the fair value gap high, once it completely fills all that in and then leaves that price area, whether that be higher or lower, once it just leaves that range, this area can become rebalance, or it does become rebalanced, because this creates an inefficient price delivery when it only offers sell side delivery on this candle number 2. So notice how it just trades down, right? You don't see any wicks covering the area from this candle's low to this candle's high. It needs to balance that out. So eventually they usually do get rebalanced, not immediately, and especially in this model that we're going to be talking about, I don't always look for it to completely reprice back to the fair value gap high, because a lot of times when it does that, and it's quick to do that, it's not really a sign to me that we're in a heavy sell program in a bearish idea. So a lot of the times, if I'm looking for fast delivery and I just want to see it take off towards the buy side target, when you're in good trades, that's usually what happens. Price will just tap into the fair value gap and just leave that price area, and you'll start to see speed and velocity towards buy side or sell side liquidity. I often like to see that, which we will talk about later in the series. I don't always want to see a complete deep retrace, because that's showing a lot of times, especially if the fair value gap is high up in the range, it's showing that price is in a high resistance liquidity run, which we'll also be talking about. But this is the basics of a fair value gap. So now we can dive into a real chart example. I want you guys to take a look at this chart. If you're new and you haven't been trading ICT for a while, just try and look for those signatures in price action that we just talked about, a bullish fair value gap or a BISI, and then a SIBI or a bearish fair value gap. So pause the video real quick and see if you could find any examples on your chart. So if you notice, when price reversed up in here, we do have this bearish fair value gap. So this is where in my trading view, I'll just have a saved template and I'll label it as a SIBI fair value gap. I just have it in red. And you can see that this is candle number 1 up here. This is candle number 2, this large candle, and this is candle number 3. So just between this candle's wick, the lower part of candle number 1's wick, and the higher part of candle number 3's wick, see how only candle number 2 went through that area? So this creates a imbalance in price delivery. So it only offered sell side delivery. You can see that we're chopping around in here. Notice price repriced to the fair value gap high. Like I talked about, when this happens, sometimes it does indicate that high resistance liquidity run. You can see what happened after that. It's not always the case, but sometimes, where it's just constantly chopping back and forth, and then it finally leaves that price range and heads lower. This is a bearish fair value gap. Now, similarly, right over here, where we actually have the exact same thing, where we do have this bearish fair value gap. So between this candle's low, this is candle number 1, we have candle number 2, and candle number 3, we have a bearish fair value gap. So when price is in sell side delivery, these are levels where I anticipate for the algorithm to reprice back to and then act as real resistance. Now later in this series, you're going to be figuring out how to pick the right fair value gaps, which a lot of people don't talk about. We'll be using a specific model, and I'll show you guys kind of the 3 main functions on how I use fair value gaps. So this series is meant to be more personal, basically how I've utilized ICT's mentorships and created my own model from it, and I'm just sharing it with you guys, sharing the refinements that I've made over the last over a year now trading ICT concepts, and hopefully it improves your trading. So we have another fair value gap right in here. You'll notice that the more time you spend looking at these fair value gaps, the easier it will be. I don't want to spend too much time on this because I'm almost positive a lot of you guys already know what this is. But this is what bearish fair value gaps look like. If we look at when price is trading higher, you'll notice that we do have a bullish fair value gap in here. This is a buy side imbalance, sell side inefficiency, or a bullish fair value gap between candle number 1's high, candle number 3's low. We do have this big fair value gap. Price trades into it, rejects it, and then trades higher. So it's just kind of consolidating in here. Here in this one, it completely wicked down. This was at 2 p.m. Wicked straight down, but the bodies did stay within that bullish fair value gaps. That is a bullish sign. Price started to trade higher. These are some examples of bullish fair value gaps. We do have examples of smaller ones. It's not always going to be this big imbalance right here. Sometimes it can just be a very small one. So all the way deep in a discount down here, we have this little small bullish fair value gap. When you are on side with smart money and you already know where price is drawing towards, that's when you refer to these bullish fair value gaps. So you're not just going on a chart and just trying to label every single fair value gap. And that's where a lot of ICT traders mess up. So I see a lot of ICT traders just starting out because I did the exact same thing. And the purpose of this series is for you guys to kind of lean on the experience of me trading his concepts for over a year. That is ICT. And learn from my mistakes. So what I did when I started out using ICT concepts is this is what I was doing. I was marking out a bearish fair value gap on the hourly time frame, and then on the same time frame, I was marking out a bullish fair value gap. So you're marking out bullish and bearish fair value gaps. That's not the most optimal way to use ICT concepts, and in fact, that's not what ICT is doing. He's not marking out both sides, both bullish and bearish PD arrays. Now, when price is in buy side delivery, he can mark out bullish or when price is in buy side delivery, he can mark out bearish PD arrays for them to be used as inversions. But the primary function when price is in a buy side delivery program isn't to extend over bearish PD arrays for the purpose of looking for sell setups out of them. You want to be looking for buy setups out of them. I know that does seem a little weird, but you'll be learning that later in the series as well. But the main purpose of PD arrays is to mark them out once you already know where price is heading. Once you know where price is heading, then you can refer to these bullish fair value gaps and you can hunt for those lower time frame setups out of those. So if you were to look at a lower time frame in here, when you're marking out this bullish fair value gap, I'm not necessarily just buying because it's a bullish fair value gap. I'm buying because the draw on liquidity is for price to target the highs above here. So I'm going to teach a model in this series where you'll be able to find the draw on liquidity. You'll be able to know which levels to target, and that'll help you to mark out PD arrays along the way and be on the right side of the curve.